Hey there. What if I told you that when most people buy a house, they don't actually own it? What they own is debt. The house itself is technically the bank's, at least for a while. That's the magic, and sometimes the trap, of mortgages. So how do they actually work? Why do banks hand out massive loans to everyday people? And how do they make money off something as simple as a house? Let's break it down. Section 1. What is a mortgage? At its core, a mortgage is simply a large loan with your home as collateral. Most people cannot afford to pay for a house worth hundreds of thousands of dollars up front, so they borrow the money from a bank or lender, agreeing to pay it back over many years, often 15, 20, or even 30. The bank takes a legal claim on your home until you have paid off every cent of the loan. If you fail to make payments, they can seize the property and sell it to recover their money. The word mortgage actually comes from Old French and means death pledge, which reflects the idea that the loan only dies when it is completely paid off or the house is taken away. Even though you live in it, decorate it, and call it your own, a large portion of the ownership technically belongs to the bank for decades. Section 2. How a mortgage actually works. Imagine you're buying a $300,000 house. You might make a down payment of around 20%, which would be $60,000 up front, and then borrow the remaining $240,000 from the bank. That $240,000 becomes your principal or the base amount you owe. On top of that, the bank charges interest, which is the cost of borrowing money. If your interest rate is 6%, you're paying an additional 6% of your remaining balance each year. Over 30 years, this interest adds up dramatically. Even though the home's purchase price was $300,000, you could easily end up paying over $500,000 by the time you've completed your loan. Each monthly mortgage payment you make is split into two parts, a portion that goes toward paying interest, and a portion that goes toward reducing the principal. In the early years of your mortgage, most of your payment goes to interest, which can make it feel like you are not making much progress. Only later do you start significantly reducing the principal. Section 3. Types of mortgages. Mortgages come in different forms depending on your needs. A fixed-rate mortgage has the same interest rate for the entire term of the loan, meaning your monthly payments are predictable and stable. This is great for homeowners who plan to stay put for many years. Adjustable-rate mortgages, or ARMs, start with a lower interest rate that can change over time based on market conditions. These are attractive because they are cheaper at first but can become much more expensive if rates increase. In some markets, there are even interest-only mortgages, where you only pay interest for the first few years before you start paying back the principal. Section 4. Why banks love mortgages. From the bank's perspective, mortgages are a safe and steady source of profit. If you make your payments, they earn a reliable stream of interest over decades. If you don't, they repossess the home, sell it, and recover their money. Either way, they rarely lose. But banks often don't just hold on to your mortgage until you've paid it off. Instead, they bundle thousands of mortgages together and sell them to investors as mortgage-backed securities. This allows them to free up cash to issue more loans, while investors make money from the interest homeowners are paying. Section 5. Why people still take mortgages. If banks profit so much, why do people continue to take mortgages? For most families, it is the only way to own a home. It is a trade-off. You agree to decades of payments, but in return, you get the stability of a home and the potential to grow your net worth over time. Section 6. Risks of mortgages. Mortgages can help people achieve their dreams, but they also come with real risks. Adjustable-rate mortgages can become unmanageable if interest rates rise sharply, doubling monthly payments. A housing market crash can leave homeowners underwater, meaning they owe more than their home is worth. Conclusion. For homeowners, mortgages can be a path to building wealth and security, but they also lock you into a massive long-term commitment. Let me know in the comments if you'd like us to break down more financial topics like this. Thanks for watching.